How to buy a house with $0 down for first-time buyer. In this video I will share with you how to buy a house with $0 down for first-time buyer. Before we dive into it, please don't forget to give a thumbs up to this video, comment, and subscribe to my YouTube channel. If you're ready, let's go. A no-down payment mortgage enables first-time home buyers to purchase a home with no out-of-pocket expenses other than standard closing costs. Other choices, like the FHA loan and the conventional 97, require as little as 3% down. In addition, house buyers across the country can qualify for government subsidies and loans to help cover their out-of-pocket expenses. This allows you to buy a house with no or very little money down. How to buy a house with no money down? A government-backed mortgage is the simplest way to buy a house with no money down. Both the VA and USDA loan programs require no money down. Not everyone will be eligible for these programs, which is fine. You still have other choices to explore. How to buy a house with no money? 1. Apply for a zero-down VA loan or USDA loan. 2. Use government assistance to cover the down payment. 3. Ask for a down payment gift from a family member. 4. Get the lender to pay your closing costs, lender credits. 5. Get the seller to pay your closing costs, seller concessions. When used together, these strategies could get you into a new home with little money out of pocket. In reality, most first-time home buyers will need at least a 3% to 3.5% down payment. That is the bare minimum for a conventional or FHA loan, which are the two most frequent forms of mortgages. While zero-down house loans are available, they are only for certain categories, such as veterans and rural home buyers. The vast majority of buyers will be able to qualify for a low down payment mortgage rather than a zero-down loan. The good news is that each state provides some form of home buyer relief. These government grant programs may cover your down payment, allowing you to avoid paying it out of pocket. Remember that as a buyer, you must also pay closing costs. However, there are various ways to get all or a portion of your fees covered and avoid paying upfront. Speak with your loan officer about ways to lower your out-of-pocket expenses. Zero-down first-time homebuyer loans. The USDA and VA loan programs allow qualified buyers to acquire property with no money down. Both are available to both first-time and repeat house buyers. However, they must meet certain criteria in order to be eligible. USDA loans, 0% down. The United States Department of Agriculture provides a mortgage with 100% financing. This program is referred to as the Rural Housing Loan, or simply USDA loan. The USDA Rural Housing Loan is not simply a rural loan, it is also offered to buyers in many suburban neighborhoods. The USDA's mission is to assist low to moderate income homeowners throughout the United States, excluding big cities. According to the USDA's criteria, almost 97% of the country's land mass is eligible. USDA loan requirements: 0% down, 640 credit score, debt-to-income ratio below 41%, 2-year employment history, income below 115% of area median income, buy a single-family primary residence, buy in an eligible rural area. Another significant advantage is that USDA mortgage rates are frequently lower than rates on comparable low or no down payment mortgages. USDA home loans may be the most affordable way to become a homeowner. VA loans with 0% down. VA loan requirements: eligible military service, 0% down, 580 to 620 credit score, debt-to-income ratio below 41%, 2-year employment history, buy a 1 to 4 unit primary residence. The VA loan is a no-money down mortgage option for members of the United States military, veterans, and surviving spouses. VA loans are guaranteed by the United States Department of Veterans Affairs. Borrowers that meet VA mortgage rules are eligible for lower interest rates and fewer requirements. The VA program is open to most veterans, active duty service members, and honorably retired service personnel. Home buyers who have served in the reserves or National Guard for at least 6 years, as well as spouses of service members slain in the line of duty, are also eligible. There is no maximum loan amount for VA loans. As long as you have good credit and can afford the payments, it's generally possible to receive a VA loan over the existing conforming lending restrictions. Furthermore, VA loans do not require ongoing private mortgage insurance, PMI. The only price is a one-time funding fee that can be rolled into your loan. When compared to conventional or FHA loans, this is a significant advantage. Finally, VA mortgage rates are often among the lowest of any home lending program. For qualifying veterans and service members, this is frequently the most affordable home buying choice. Now let's talk about low down payment first-time home buyer loans. A zero-down mortgage is not available to everyone. However, if you choose a low down payment mortgage and use a government grant or loan to cover your upfront expenditures, you may still be able to buy a house with no money down. If you decide to go this route, here are some of the best low down payment mortgages to consider. Conventional loans with 3% down. Conventional 97 loan. Fannie Mae Home Ready. Freddie Mac Home Possible. Most home buyers consider a conventional loan to be a normal mortgage. These mortgages are not guaranteed by the government, unlike FHA, VA, or USDA loans. They do, however, offer flexible standards that can make it easier for first-time purchasers to qualify. Some home buyers believe that a typical loan requires a 20% down payment. However, standard programs begin at only 3% down. The Home Ready and Home Possible programs are particularly beneficial to first-time home buyers. They have fewer qualification requirements, such as larger DTI limits and flexible income sources. Furthermore, these loans have lower rates of private mortgage insurance, PMI, than other traditional mortgages. While requirements differ slightly depending on the lender and loan program, conventional loans all adhere to the same basic guidelines established by Fannie Mae and Freddie Mac. Conventional loan requirements: 3% down, 620 credit score, debt-to-income ratio below 43%, in most cases, 2-year employment history, loan amount within conforming loan limits, buy a 1 to 4 unit property. If you have a low down payment but a good FICO score, a conventional loan is frequently the best option because good credit entitles you to a reduced interest rate. Moreover, unlike the FHA program, you may usually cancel private mortgage insurance, PMI, premiums after a few years, possibly saving you hundreds of dollars on your monthly mortgage payment. FHA loans with 3.5% down. The FHA loan is an excellent choice for first-time home buyers with bad credit. The Federal Housing Administration backs this program, which is known for its relaxed credit requirements and low down payments. With an FHA loan, you can put down as little as 3.5% if your credit score is 580 or above. A conventional mortgage, on the other hand, requires only 3% down and a FICO score of at least 620 to qualify. You can even receive a mortgage with a credit score of 500 to 579 if you can put down at least 10%, according to FHA requirements. In actuality, however, it is more difficult to find lenders who will accept FICOs below 580. FHA loan requirements: 3.5% down, 580 credit score, debt-to-income ratio below 45%, in most cases, 2-year employment history, buy a 1 to 4 unit primary residence, loan amount within local FHA loan limits. The primary disadvantage of an FHA loan is that you must pay upfront and monthly mortgage insurance costs, MIP. These are more costly than normal and USDA mortgage insurance. However, if an FHA loan gets you into a property when others won't, the MIP fee is frequently well worth it. Also, keep in mind that you can refinance to a lower interest loan if your credit improves. How to get a down payment for a house? Most home buyers are required to put some money down. The good news is that you can get your down payment in a variety of ways. If you're having problems saving for a home, one of these tactics could help you make the required down payment on a mortgage. 6 ways to fund a down payment. 1. Use your savings. 2. Cash out investments. 3. Get a cash gift from a family member. 4. Apply for a down payment grant. 5. Borrow from your 401k. 6. Buy with a partner or friend. Mortgage lenders will normally take any of these as a down payment. However, depending on how you pay, there may be additional requirements to be aware of. For example, home buyers who use gift money for a down payment must provide a gift letter from the donor. In addition, the lender will want to see a clear paper trail demonstrating where the funds came from and when they were transferred into your account. Talk to your loan officer if you plan to use money other than your savings for a down payment, or if you have questions about other options. They will be able to clarify your options and inform you of any additional financing requirements. Down payment assistance. Many first-time home purchasers are eligible for state and local government cash assistance. If you can't afford the down payment out of pocket, these down payment assistance, DPA, programs can help you buy a house. Some home buyer aid programs provide grants or loans of up to 5% of the purchase price. If you use a low down payment FHA or conventional mortgage, DPA may cover your full down payment, leaving you with no money out of pocket. Keep in mind that you must still pay upfront closing charges. There are almost 2,000 DPA programs around the U.S., with help available in every state. Each program has its unique set of rules, but the majority of them need you to be a first-time home buyer with a low to moderate income. The amount of money you could receive also varies by program. For example, one down payment assistance loan in New York City may provide up to $100,000 for qualified buyers, while another in Arkansas may provide only $1,000. If you want to apply for a home buying grant, the best place to start is by contacting your local housing finance authority or a mortgage lender. Either one can inform you about local DPA possibilities and assist you in determining whether you qualify. Now let's talk about closing cost assistance. As previously stated, the down payment is not the only upfront cost when purchasing a property. Closing costs are also the responsibility of the buyer. These are the lender and third-party expenses that are required to set up your house loan, things like the credit report, home appraisal, title search, and underwriting fees. Even if you qualify for a no-money down mortgage, you must meet your closing fees if you want to buy a house with no money. Fortunately, there are several options for getting assistance with your closing costs. Most down payment assistance programs also provide closing cost relief. However, the grant or loan you receive will most likely not be sufficient to cover both the down payment and the loan fees. As a result, you may have to pay the balance yourself. First option for closing cost assistance: seller-paid closing costs. A motivated seller may be willing to cover your closing costs. Typically, you pay a little more for the home, and the seller returns that extra cash to repay your fees. When you go this route, you're essentially rolling the expense into your home loan. Second option for closing cost assistance: lender-paid closing costs. Some mortgage lenders provide incentives to home buyers, such as covering a portion or all of your closing expenses. This can be useful if you're short on funds, but keep in mind that no closing cost mortgages typically have higher interest rates. As a result, you may end up paying much more throughout the life of the loan. To summarize, if you qualify for a zero-down loan and convince the seller to cover your fees, you may be able to buy a house with no money down and no closing costs. For this to work, the seller must be extremely driven, implying that there is little competition for the residents. You could also request that the lender pay your closing costs. However, lender-paid closing fees are usually accompanied by higher interest rates. So, while you may save money up front, you may end up paying significantly more over the life of the loan. If you qualify for down payment assistance, the funds can also be used for closing fees as well. However, most down payment incentives are insufficient to cover both the down payment and the loan fees in full, so anticipate paying at least a portion of your closing costs out of pocket. That's all for this video. I hope you enjoyed it and thanks for watching. Please don't forget to like, comment, and subscribe to my YouTube channel so I can continue to provide you with valuable content like this. See you next time.